Welcome back to the Deep Dive.
Great to be here.
Today, we're taking that Q1 2025 earnings call from SNDL and, well, cutting through the noise.
Yeah, there's always a lot in those calls.
Our mission, as always, is to pull out the key financials, the strategic stuff, the management insights, basically give you the important bits quickly.
A shortcut, essentially.
Exactly. Think of it as your fast track to understanding what really matters from this update. We'll hit the numbers, look at the different business parts, their strategy, and what it all means, especially the strategic review they mentioned.
That definitely caught my eye.
Okay, let's unpack this. Where do we start? The big numbers.
Yeah, let's start with the top line. Overall net revenue for Q1 2025 was 205 million Canadian dollars.
Okay, 205 million. How does that compare?
It's up slightly, 3.6% compared to the same time last year. But the interesting part is why it's up.
Go on.
Well, their combined cannabis business saw really strong growth, 16.8%. And that growth did the heavy lifting, really, and more than offset a decline they saw in their liquor retail segment.
Ah, okay. So liquor dipped, but cannabis was strong enough to push the total revenue up. Did that help profitability too?
It absolutely did. Gross profit came in at 56.6 million Canadian. That's up a solid 12.4% year over year.
Wow, okay. So profit grew much faster than revenue, margin expansion.
Exactly. You can see the operational improvements there. Led to a big jump in gross margin, 220 basis points, so 2.2 percentage points higher.
And what was the actual margin figure?
They hit a record gross margin for the quarter, 27.6%. Management seemed pretty pleased with that, especially because Q1 is usually their lowest revenue quarter seasonally.
Hitting a record margin in your weakest quarter.
Yeah, that does suggest something's working better underneath, right? Yeah. How did that flow down the P&L operating income?
Adjusted operating income for the quarter was 9 million Canadian dollars. But there's a bit of a story here.
Oh.
Yeah, that number was impacted by a loss from their Sunstream portfolio. That's their investment arm. About 4.5 million loss.
Okay, was that an operational loss? No, it was a valuation thing. The market price for cannabis credit, in the bond market went down. So they had to mark down the value of those investments.
Right, a paper loss based on market prices.
Exactly. And the reason it's significant is that it created a big swing compared to last year, Q1 2024, when they actually had a positive adjustment from Sunstream.
Ah, so a valuation gain last year became a valuation loss this year.
Precisely. That year-over-year difference just from those Sunstream valuation changes was about $13.6 million. So it kind of masked some of the underlying operational gains this quarter.
Okay, that makes sense. The core business improved, but the investment side had that valuation headwind compared to last year.
Got it. What about actual cash, free cash flow?
Free cash flow. It was just slightly negative. Minus 1.1 million Canadian for the quarter.
Okay, negative 1.1 million. How should we think about that number?
Well, you have to consider the context. It was Q1, their seasonally lowest revenue quarter, and they mentioned having to rebuild inventory after the holidays.
Right, so cash outflows for inventory. Yeah. But even with those pressures, that medical 1.1 million figure was actually a $5.3 million improvement compared to Q1 last year.
A 5.3 million improvement in free cash flow year over year, even with restocking.
Mm-hmm. They put it down to the better earnings we talked about and also better working capital management.
That really does underline the efficiency point, doesn't it? Being almost break even on cash in the slowest quarter while rebuilding stock.
It does. And management sounded pretty encouraged by that, given that cash flow usually gets stronger in the second half of the year for them.
Okay, good context. Let's dive into the segments then. Where did these results actually come from? Let's start with liquor retail. You said that was down.
Yeah, liquor retail. Net revenue was $109.5 million. That was a 5.7% decline year over year.
Why the decline?
They pointed to two main things. One, there was one less day in February this year, leap year effects from last year. And two, the timing of Easter shifted.
Ah, the calendar effects.
Right. They reckon those two things accounted for about 4 percentage points of that decline. So if you kind of normalize for that, the underlying revenue decline was closer to 2%.
Okay, so not quite as steep as the headline number suggests.
Exactly. And they said the 2% underlying decline was actually a slightly better trend than they saw last year.
And profitability in liquor.
Well, gross profit was down because revenue was down, obviously. But they did manage to improve the gross margin in that segment. It hit 25.4%, which was up 60 basis points or 0.6 points year over year.
So they controlled costs or improved pricing mix there?
Seems like it. Operating income in liquor was only down a little bit, came in at $2 million. Lower operating expenses mostly offset the lower gross profit.
Yeah.
Although There was one other factor.
What was that?
They mentioned lapping a prior impairment reversal. Basically, last year's Q1 benefited because they wrote back up the value of some assets, which boosted profit then. They didn't have that benefit this year, making the comparison look a bit worse.
Got it. A one-off benefit last year makes this year's comparison tougher. Okay, let's switch to cannabis retail. That's where the growth was, you said.
Yeah, cannabis retail looks strong. Net revenue was up to $77.5 million. That's an 8.7% increase year over year.
Nice. What drove that? New stores, existing stores?
Both, actually. They had a really solid 5.2% increase in same-store sales.
Over 5% same-store sales. That's pretty robust in the Canadian market right now, isn't it?
It really is. Shows good execution at their existing locations. Plus, they got contributions from newer store openings as well.
And the profitability in cannabis retail.
Gross profit was up overall because of the revenue growth. The gross margin itself dipped slightly, about 40 basis points year over year. But, and this seems important, they noted the margin trend improved during the quarter. The 25.3% margin they reported for Q1 was actually better than their average and their exit margin from 2024.
So the margin direction is positive even if the year-over-year number was slightly down. What about operating income?
Big jump there. Adjusted operating income rose by over $6 million compared to last year, reaching $5.2 million. That was driven by the revenue growth, better cost control in the SG&A line, and they also benefited from lapping a prior fixed asset impairment. So similar to liquor, but in reverse, they didn't have the drag from writing down assets this year that they did last year.
Makes sense. Okay, last segment, Cannabis Operations. That's the growing and making side, right? You said this had the biggest P&L improvements.
Correct. This was really the standout, I think. Net revenue hit $34.3 million. That's up an impressive 53% from last year.
53%, wow. Was that organic?
A big chunk of it, $10.2 million, came from the Indiva acquisition that closed late last year. So that acquisition is clearly contributing.
Right, the edibles company. And the profit in this segment.
Huge improvement. Gross profit jumped significantly, mainly because of massive margin expansion. The gross margin reached 26.8%.
And how much did the margin expand by?
Get this, 12.4 percentage points year over year.
12 points?
Yeah.
In one segment. That's enormous. What drove that?
Management pointed to their productivity program kicking in, plus getting the initial synergies from integrating Indiva. Things like better deals on supplies, more efficient manufacturing, improvements in cultivation. It all added up.
Clearly showing results there.
Yeah.
And operating income for cannabis ops.
It turned positive, came in at $2.4 million. That's a $1.3 million improvement from last year, even though they were also lapping a benefit from Q1 2024 related to writing off some bad debt.
So strong underlying improvement, even with that comparison headwind. Okay, paints a pretty positive picture operationally, especially in cannabis. Let's shift gears to the bigger picture strategy they talked about. They framed it around 3 pillars.
Right. Growth, profitability, and people.
Okay, growth first. What do they highlight?
Well, they emphasized cannabis retail outperforming the market, again citing that 8.7% growth and the strong 5.2% same-store sales as proof, that consumers trust them and they're executing well.
Did they mention market share?
Yeah, they reckon they gained about 0.3 percentage points of share year on year. They also talked about the deal to buy 32 stores from 1CM, which they announced after the quarter ended.
Right, the post-quarter acquisition?
Yeah, expected to close end of Q3. They see that adding exposure to new store formats and potentially driving more organic growth later. And of course, that 53% growth in cannabis operations leverages the Indiva platform they acquired.
Okay, growth seems on track, especially in cannabis. What about the profitability pillar?
On profitability, they kept pointing back to that $5.3 million year-over-year improvement in free cash flow. Linked it to earnings growth and better working capital management, as we discussed.
Any specific savings or improvements?
Yeah, they mentioned $3 million in productivity gains in Q1, mostly from cannabis operations, those procurement, manufacturing, cultivation efficiencies. They also called out $4.5 million in data licensing revenue this quarter, which helped the margin.
It's a licensing. Interesting.
And on overheads, they achieved $4 million in savings in Q1 from that restructuring program they started last year. They said it's on track now at an annualized run rate of $17 million, which is about 85% of their overall target.
So cost cuts are definitely contributing. And the third pillar was people. What was the focus there?
Yeah, they consistently talk about their people being a competitive advantage. So the focus was on things like development programs, creating good work environment, talent management, improving performance reviews, getting feedback through employee focus groups, Also integrating the HR side for the Indiva folks smoothly.
So investing in their team.
Right. And they mentioned positive feedback on new total compensation letters designed to better align everyone's incentives with company goals.
Okay, this seems like a good point to pivot to what might be the biggest news from that formal strategic review. What's the deal there?
Yeah, this is definitely the big one to watch. The board has officially kicked off a formal strategic review.
And what are they reviewing specifically?
Two main things. Their exposure to U.S. multi-state licensed cannabis businesses and their current stock exchange listing status.
Okay, so basically, should we stay listed where we are, which stops us from directly operating in the U.S. cannabis market? Or should we look at changing things up, maybe a different listing, a different structure?
That's the core question. Exactly. A change could give them the flexibility to manage a broader North American operation and potentially buy or merge with U.S. licensed cannabis companies.
And what's management's take on this?
They think they're in a pretty unique spot. They feel they can be proactive, take the driver's seat, as they put it. They believe they have the team and the expertise to do complex deals. And they're looking at opportunities both north and south of the border to maximize shareholder value.
Now, how would they actually get into the U.S. market? Because their current listing restricts that, right?
Right. And this is where it gets really interesting. They explain that they already have significant capital tied up in the U.S. through their Sunstream investment vehicle.
The one that had the valuation adjustment.
Yeah. The very same. It holds credit investments loans, essentially to U.S. cannabis companies. Many of those loans are currently being restructured because the borrowers are struggling.
Okay. So what happens in a restructuring?
Well, they expect these restructurings to finish up in the coming months. And they anticipate that their senior loans will likely convert into a mix of equities, actual ownership stakes in those U.S. companies, and other types of securities.
Wait a minute. So their path into the U.S. isn't necessarily about writing a big new check for an acquisition. It's about converting debt they already hold into ownership.
That seems to be the primary path they're signaling, leveraging their existing capital exposure through Sunstream, which means potentially entering the U.S. operational landscape without needing a massive immediate cash injection or issuing a ton of new shares.
That's quite a different approach than just buying a U.S. company outright. Do they see that as an advantage?
They absolutely do. They framed it as a potential competitive edge. Being a creditor in these distressed situations might let them gain control or significant equity stakes at valuations that could be much lower, potentially, than what you pay in a typical M&A deal in the hot U.S. market.
A sort of backdoor entry through distressed debt conversion. Fascinating. But why do they think they can succeed where others might struggle, especially coming from the Canadian market?
That was a key part of their argument. They basically said that surviving the really tough Canadian market, dealing with massive oversupply, infrastructure write-downs, brutal price wars, partly fueled by, illicit market competition and tax issues, has forged serious discipline.
Trial by fire, essentially.
Pretty much. They feel the lessons learned in Canada about lean operations, managing labor efficiently, optimizing real estate, using automation, streamlining manufacturing. They called this Canadian experience a massive asset.
So they think that tough Canadian experience actually prepared them well for the U.S.
That's the pitch. They believe that discipline is highly transferable to the fragmented and challenging U.S. state markets. They stated pretty clearly they think they have the right people, the capabilities, the balance sheet, and the capital base to make it work.
So the Canadian hardship is now viewed as a competitive advantage for entering the U.S. market via these distressed situations. That's quite a narrative.
It is. Now, they were very careful, of course, to put the brakes on any immediate conclusions.
Right. The usual disclaimers.
Exactly. No decisions made yet from the review. No guarantee any specific deal or listing change will happen. They'll only update if and when the board actually approves something concrete.
Understood. Still a very significant development to monitor. Did they mention anything else on the outlook side? What about M&A back in Canada?
Yeah, they confirmed they're still actively looking at Canadian retail M&A, both opening new stores organically and buying existing ones or portfolios. They said deploying capital to build a dominant Canadian retail footprint is still a top priority.
So they're still focused on Canada retail growth too.
Definitely. They mentioned getting unsolicited offers, scouting locations for new builds, and keeping an eye on medium and larger portfolios that might come up for sale. They feel the timing of the 1CM deal closing later this year gives them a bit of breathing room to focus internally before maybe doing another deal.
And what about that loyalty program they mentioned?
They seem quite excited about that. See it as a better way to talk directly to customers, offer them real value for sticking with their stores, and have a channel for promotions, new products, that sort of thing.
Could be powerful if done well.
Yeah, and they hinted at potentially expanding it across both their cannabis and liquor store brands eventually.
Interesting. Okay, let's just briefly touch on the regulatory and macro stuff that came up. Did analysts ask about Canadian regulations? Excise tax, maybe?
They did. On the big one, potential federal excise tax reform management used the phrase cautious optimism, following the election and some committee recommendation. But they're pretty clear. They are not convinced that material change, like a big cut to the excise tax, is going to happen in the near term.
So don't hold your breath for immediate relief on that front, is the message.
That seems to be their read, yeah. At least not imminently. But they did point to other positive regulatory changes happening.
Like what?
Things at the provincial level, retail rules, some easing of packaging restrictions, and they expect a change to edible milligram limits later this year, which they think could be good for that category.
So smaller incremental improvements are happening, just not the big excise tax overhaul yet.
Exactly. Important marginal reforms, as they put it, but separate from a big tax drop right now.
Got it. And any worries about trade wars, tariffs, that kind of thing?
They addressed that. So they're not seeing any material disruption from the current tariff situation.
Okay. Did they quantify their exposure?
Yeah, they said about 5% of their liquor business is U.S. products, like Kentucky bourbon. So maybe some shelf shifts there if things escalate, but they're working on private label alternatives. On the cannabis side, maybe some slight inflation pressure on packaging costs, but nothing they see as materially hurting margins.
So overall, they feel the Canadian industry and their business is relatively insulated.
Generally, yeah. They believe they'll fare reasonably well compared to some other sectors if trade disputes continue or worsen. That was the view on the call anyway.
Okay, so bringing this all together for you, the listener, why spend time wading through all these details from one company's earnings call?
Well, I think it shows a company that's clearly making progress, operationally hitting record margins, improving cash flow trends.
Right, the execution seems solid.
Yeah, and they're navigating some complex markets. But the really big thing, I think, is this potential strategic shift. Exploring U.S. entry, using their existing capital in a pretty unconventional way, and rethinking their whole listing structure.
It gives you a window into not just SNDL, but maybe broader trends and strategies emerging in the North American cannabis space.
Exactly. These details matter. As you listen to all this, what signals really stood out to you?
Definitely something to ponder. Okay, let's transition now, as we often do, to our This Is Not Financial Advices segment.
Yes, crucial disclaimer time. Everything we've discussed here is purely for informational and illustrative purposes. It is absolutely not a recommendation to buy or sell SNDL or any other security. Please, always do your own research or consult a professional.
Couldn't have said it better. But with that massive disclaimer in place, let's talk about an outrageous but plausible idea purely based on that strategic review discussion.
Okay, so focusing just on that potential U.S. entry pass via the Sunstream debt.
The distressed debt conversion idea.
Right. An outrageous but plausible scenario or trade idea someone might consider could revolve around that. The outrageous part is betting that they can successfully navigate these really complex debt restructurings across multiple struggling U.S. companies.
Which is far from guaranteed.
Far from it. And assuming that this tricky path actually results in them getting control of or significant stakes in valuable U.S. assets at a deep, deep discount compared to what those assets might fetch in a normal M&A market. That's a big leap of faith.
Okay, that's the outrageous part. What makes it plausible?
The plausible part comes straight from management's playbook, from what they actually said on the call. They explicitly outlined this as their potential path. They framed it as leveraging capital already out the door via Sunstream.
So avoiding huge new cash outlays or dilution.
Potentially. And bypassing maybe those high U.S. M&A valuations through this non-traditional route. Plus, they're betting heavily on their Canadian experience, that operational discipline being the key to turning those distressed U.S. assets around.
So the trade idea, hypothetically, is a long position betting on them successfully executing this complex debt-to-equity restructuring strategy in the U.S., fueled by their Canadian-honed operational skills, leading to significantly undervalued asset acquisition.
That's the essence of it. It's a bet on a very specific, complex, non-traditional pathways succeeding, creating value arbitrage. Definitely speculative, focusing on restructuring skill and operational transfer more than just organic growth.
And one more time.
This is emphatically not financial advice. The risks here are substantial restructuring failures, integration challenges, regulatory hurdles across states. The list goes on. Due diligence is absolutely critical.
Absolutely. Okay, so let's wrap up this deep dive on SNDL's Q1 2025 call.
We saw strong Q1 operational numbers, record margins, that improving free cash flow trend.
Key initiatives like Canadian retail growth and the cost-cutting seem on track.
But the big headline, really, is that formal strategic review, exploring U.S. entry via existing credit investments, potentially changing their listing. That's the major development to watch.
And remember, folks, nothing we talked about today is financial advice.
So maybe a final thought for you to mull over. Management believes their tough Canadian experience is actually a massive asset for the U.S., and their plan is to potentially enter the U.S. by converting distressed debt, not through typical acquisitions. Does that unique approach, that specific strategy, fundamentally change how you think about competitive advantages or maybe barriers to entry, or even how you value companies playing in the North American cannabis sector?
Something to think about indeed. Thanks for joining us for this deep dive.